Foreign exchange rate. Definition: foreign exchange rate is the rate at which one currency is exchanged for another. It is the price of one currency in terms of other currencies. Systems of foreign exchange rates. There are three major exchange rate systems: fixed exchange rate system, flexible or floating exchange rate system, managed floating system. Foreign exchange rate system: fixed exchange rate system, flexible exchange rate system, managed floating system. Fixed exchange rate system. Fixed exchange rate system is one in which the exchange rate between two or more countries is set by the monetary authorities, government, and central bank of a country. Advantages: create confidence, encourage international trade, encourage long-term capital plans, no fear of speculation. Disadvantages: difficulty is in making economic policies, encourage black market, no possibility of fixed exchange rate, requires large reserves. Advantages: create confidence. Fixed exchange rate system create confidence among the exports and imports. The rate excites and fixed for contained period of time. Encourage international trade. It encourages international trade since prices of goods exported or imported are predictable. Table offered rates for commodities are fulfilled confidently. Encourage long-term capital plans. It encouraged long-term capital plans in a smooth manner. Foreign investor will not be worried because of any uncurrently arising from frequency changes in exchange rates. No fear of speculation. There is no fear of any advisor effect of speculation on an exchange rate to shatter the confidence of the trader. Disadvantages: difficulty in making economic policies. It makes difficulty for a government to freely make economic policies within the country. It tries to maintain fixed rate and due to that full employment cannot be followed because the foreign exchange market fluctuates and continuous adjustment has to be made by pegging encouraged black market. The policy of fixed exchange rate encouraged black market in foreign currencies. No possibility of fixed exchange rate. Fixed exchange rates cannot be fixed forever, so it is not possible to have rigidly fixed exchange rates on long term basis. Confidence of trader is not possible for long term trade agreements. Requires large reserves. Under this system, large reserves of foreign exchange are required to be maintained by the government to pig or de-pig F.E to maintain her on rate. Flexible or floating exchange rate system. A flexible exchange rate is one in which the foreign exchange rate is determined by the market forces of supply and demand for foreign exchange. In freely floating exchange rate system, there is no interference on the part of the government of the country to determine exchange rates. If the imports are more than export, the share rise of foreign currency and vice versa. Advantages, disadvantages. Easy to maintain policies does not require large reserve, continual adjustment, sample to operate, create risk, encourage speculation, destabilizing effect, encouraged inflation. Advantages easy to maintain policies under this system. The government can independently follow any internal policy about prices, employment, and investments. Does not require large reserve. Under this system, there is no require for keeping large reserve of foreign currency by the government to peg or de-peg rates. Continual adjustment. There is continual adjustment in the exchange rate according to the conditional in exchange market due to a change in international rates of exchange. Sample to operate. This system is sample to operate because exchange rate move up and down automatically and freely to equalize demand and supply for of foreign currencies. Disadvantages create risky currency change in exchange rates, create risk for importers and exporters due to uncurrently the trade may decline. Encourage speculation. It encourages speculation in foreign exchange market. Some people may start hoarding or dishoarding because of futures change in rates, destabilizing effect, wide fluctuations in exchange rates, depress the industries producing internationally traded goods. Thus, the production houses may destabilize it, encourage inflation. It encourages inflation in a country. The value of sis- currencies of developing countries fall and push up price level. Managed floating system. Under this system, the currency of a country is allowed to float on foreign exchange market determines its exchange rates according to market forces. The government or central bank may intervene from time to time in currency market. The basic theory of exchange control is that the government orders to all exports and foreign exchange dealers, brokers, etc. to surrender all their foreign exchange directly to the central bank. These are in return compensated with the local currency at a stated rates. The central authority then decide how to allocate and retain foreign exchange among different channels. The different methods of exchange control are as follows. Exchange pegging. It's meant to fix the exchange rates over or under the equilibrium rate in case it is overvalued, i.e., over the equilibrium level. It is called pegging up. Visa vice versa. When it is undervalued, it is called pegging down or depegging. Exchange pegging tool is basically used to iron out temporary fluctuation in the exchange rates. Exchange equalization account. It is a fund which is set up by the central authority. The reserve of this fund are used to restore exchange rate once equilibrium has been disturbed. This is done by buying and selling foreign currencies by the government or monetary authorities. Multiple exchange rate. Under this system, as the name suggests, different rates are prescribed by the central bank from trading with different countries. Rate also differ for trade of different commodities. Basically, there are two aims of such policy. First, to encourage import or export of contain goods to contain countries. Secondly, to earn maximum possible foreign exchange to control rates. Quota systems. Quota systems are the part of import policy. They are used to retain fixed amount of foreign exchange for import of various items. Quota system, besides acting as an exchange control, also help to check import of unwild, unneeded, and luxurious goods. Blockade accounts. Blockade account technique technique varies from ordinary blocking to the complete freezing of foreign exchange accounts. This is that Pakistani government did after test of nuclear devices. In this technique, the transfer of funds from any foreign exchange account of the country is restricted by the government. Clearing agreements. Clearing agreements are used to improve the liquidity of national trade. Under such agreements, central banks of two countries negotiate which, which other are suitable exchange rate for a particular future periods. The significant features of this system is that the important deposit by the payment which the government in its own currency. The importer is paid by the government in his own currency. The balance arising due to difference in exchange rates is settled by central banks themselves. Barter trade, compensation agreement, although barter came to an end with invention of money, yet it is used sometimes in international trade. Under compensation agreements, the trading countries simultaneously trade is equally value of goods. They import and export goods of same value. Thus, no need of change of currency arises. Receivables or payables. This helps the country to maintain its foreign exchange reserves and exchange rate. Standstill agreements. Rescheduling. Standstill agreements or rescheduling means altering the schedule of payment of loan. Debtor countries may negotiate with the creditor country to repay debts in easy installments after some time in future. Payment agreement. Under payment agreements, the debtor country enter into a settlement with the creditor country, whereby the creditor country agrees to have more and more imports from debtor countries. On the other hand, debtor country tends to have minimum imports from creditor countries. This also help in clearing POP deficits. Summing up, these are different exchange control which are applied from time to time by different countries to maintain their exchange rates in affordable area and to turn BOP affordable in the modern world. The highly developed countries have restricted developing countries from the purchasing and strong protectionism policies. Pakistan also has a member of WTO is unable to impose extra tariffs and imports. Due to this, such developing countries often experience exchange fluctuation, so these exchange control methods are adopted by different countries to tackle this situation to control unnecessary outflow of F.E. Dot system adopted by Pakistan. Pakistan is presently following the system of managed floating exchange rates. State Bank of Pakistan fixes the rate of various currencies daily. Determination of foreign exchange rates. Under floating exchange rate system, rule of demand and supply equilibrium in the foreign exchange market. The foreign exchange rate is determined by the demand and supply of foreign currency. Demand for foreign exchange. Demand for foreign exchange is a schedule or a curve showing graphically the different quantities of foreign exchange demanded at foreign rates of foreign exchange. Other things remaining the same. The relationship between the quantity of foreign exchange demanded and the rate of foreign exchange in inverse. A fail in the rate of exchange is followed by an increase in the quantity of foreign exchange demanded and a rise in the rate of exchange is followed with by a decrease in the quantity of foreign exchange demanded. The demand curve DD slopes downward to the right. Supply of foreign exchange. Supply of foreign exchange is a schedule of a curve showing graphically the different amount of foreign exchange which are available at different rates of foreign exchange. Other things remaining the same. There is direct relationship between the supply of foreign exchange and its rates. A high rate of foreign exchange tends to increase its supply and a lower rate reduce the supply of foreign exchange. The supply curve as slopes upward positively sloped. Axis supply, axis demand. R2 R R1 O D C D B F S Q G S E. Equilibrium rate of foreign exchange. The equilibrium rate of foreign exchange is determined at the intersection of supply and demand. In the above figure, the equilibrium rate of exchange is or which where the total quantity demanded OQ is equal to quantity supplied OS. At any other exchange rate, the foreign exchange market will be in a disequilibrium. For example, if the rate of exchange is OR2, there is an excess supply of foreign exchange equal to BC. On the other hand, if the rate of exchange is OR, the demand for foreign exchange exceeds the supply, which is equal to FG. The market is in disequilibrium. Difference between capital market and money market. Money and capital markets are the financial fields of economy. If any of these market crashes, the economy may crash. Money market. Introduction. Money market is such a market in which short-term monetary assets, also called near money, are pushed and sold. It is a collective name given to all those institutions that deal in which short-term credit instrument The dealing are mainly done by central bank and commercial banks. Besides some non-banking financial institutions, we can understand the term money market more accurately with the help of following definitions. Definitions according to G. Crowther. The money market is the collective name given to the various firms and institutions that deal in various grades of near money. According to S. M. Goldfield and L. B. Chandler, in money market short-term debts obligation are traded. Money market headed by central bank. Short-term loans deals in near money composite of survival sub-markets. Capital market introduction. Capital market is the market for long-term debts when funds are lent for a period more than 1 year. The transaction will be a part of capital market. The capital market funds are used to finance long-term investment involving creation of fixed assets such as plant and machinery. Capital market includes all such challenges through which savings of the economic are accumulated and are made available for investments in capital projects. The meaning of capital market can be more accurately understood by following definitions. Definitions according to Khwaja Ahmad Said. Capital market is a medium for allocation of long-term funds, usually for capital formation. According to Paul the Dot simulation, capital market is a market in which financial resources, money, bonds, stock are traded. This long which financial intermediary are institutions through which savings in the economy are transferred to investor. Capital market headed by stock exchange long-term funds deals to financial resources transfer saving to investor. Destination between money market and capital market. Money market, capital market difference to definitions. The money market is the collective name given to the various firms and institutions that deals in various grades of near money. Capital market is a medium of allocation of long-term funds, usually for capital formation. Time factor. This is for short-term financial less than 1 year. This is for medium and long-term financial more than 1 year. Instruments. The instrument of money market are promissory note, bills, etc. The instrument of bill capital market are corporate bond, barrier bonds, and debenture and stocks. Liquidity. The instrument of money market are highly liquid. The instrument of capital market are not liquid. Participation. Mostly commercial banks plays creditor role in money market. Most of development financial institutions play creditor role in capital market. Financing. Financing. Money market financing the working capital needs of firm and reserve requirements of various Commercial banks. Capital market permits financials to specialized sector of economic for medium and long-term projects. Institution. The primary institution or bill markets can loan market acceptance and discount houses. Here the major institutions include development financial institutions, insurance companies, government assistance. It provides government with short-term loans. It provides government with medium and long-term loans. Components of money market are called money and tertiary bill market. Segments of capital market are non-securities market and security market. Purpose. The purpose of this market is to increase saving and investment in developing country. Basically, it helps commercial bank and government on different grounds. Conclusion. The role of both money market and capital market is of utmost importance in the development of a country. Economic both markets are different in nature but plays vital role in providing assistance to individual as well as institution.